Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the best dividend stocks to buy right now. And for more videos like this one, remember to go and smash that like button right now, comment down below your favorite dividend stock, subscribe if you are new, and without further ado, let's jump right into today's stories. So today we're going to be analyzing an article where this author actually analyzes the top 64 dividend aristocrat stocks from the S&P 500. Now in this video, we are not going to go over all 64 dividend aristocrats. We're only going to be highlighting the top 15, which you see on screen in this red rectangle. However, if you want to know the other 64 companies that are all comprised on this list holistically, you can see all of their ticker symbols underlined right here at the bottom of this graph. However, today we're mainly just going to be focusing on the top 15 because I don't know why we would want to talk about companies that don't place in the top 15. Also, if you didn't know what a dividend aristocrat is, it's a company that pays a dividend who has also increased that dividend payment for around or over 25 years in a row. So this is 25 consecutive years of constant and consistent dividend increases, which means that if you buy this company right now, its current dividend is going to grow as time progresses. However, we're going to be very picky because for this list, just to be included, the company has to be a part of the S&P 500 index. Number two, they have to be a dividend aristocrat, which again means they have increased their dividend year over year for 25 years consecutively, which means for 25 years in a row, their dividend payments have increased every single year in those 25 years. Another criteria is that this company has to have a market cap of over or around $3 billion, and all of these companies are going to have to meet the requirement of having around $5 million worth of value traded on the open stock market every day, or at least every trading day for the last 3 months. So clearly these are going to be somewhat popular companies, and I can't wait to dive into this article. Now this article is absolutely extremely in-depth, and it's going to go over the head of a lot of newer investors. If you haven't been in the stock market for over 5 years, you're not going to understand this entire article, which is why I have already read through this article. I'm going to summarize it, and I'm going to give you the main takeaways of this article. However, if you want to read the entire thing for yourself, as this author analyzes all 64 dividend stocks, I'm going to leave a link to it down below in the description. Now for these companies, we are also going to use key metrics to value these companies. The first metric that I'm going to highlight is the amount of years that they have consecutively increased their dividend, because a lot of these companies have increased their dividend payment consecutively for well over 25 years in a row. Remember, 25 years is just the minimum. Now the author of this article has a lot of other criteria that we're not really going to dive into because I think it's going to go over investors' heads and they really don't need to know all of this. However, what we're going to focus on is the amount of years that they have increased their dividends. We're going to look at their dividend safety score, and we're going to determine if we should buy this company right now and if it's a good price. Are we buying this company at a discount, which means we're getting a good deal on the company, or are we buying it at a premium? So we're going to have price targets for these companies and the fair value estimate for the company, which means that if the current stock price is trading below the fair value estimate, that means it's a good buying opportunity, especially for these dividend stocks that we're about to dive into. Now, before I go over our first dividend stock, I want to make sure that you all know what drip investing is. I have a drip investing enabled for my dividends, which means that every time I receive a dividend from a company, my brokerage account will take that dividend and automatically reinvest it back into that company. So my next dividend is going to be slightly bigger, and it's just going to continue to grow my overall holding for that particular company. Now, if you're using dividends for a way of passive income and you actually use the dividend, then drip investing might not be for you. However, because I don't need dividends anytime soon, I actually really like to reinvest my dividends through drip investing. So go check out if your brokerage platform actually offers that. And with that out of the way, I want to dive in to our first 4 companies, which are going to be Johnson & Johnson, Procter & Gamble, Automatic Data Processing, and Walmart. Now for this particular video, we really want to focus on defensive companies. So as you can see, above every defensive stock, I have a red dash. And when we go and look to the actual chart, you're going to be able to see that I actually have a check mark next to the companies that are quote unquote defensive companies. And if you didn't know, a defensive stock is a very safe stock that reflects a company which has a very stable performance in any economic condition. So when the overall market is very volatile and the prices are going going up and down, and there's even threats of a crash, these are the companies that investors tend to run to. And the first company on this list is none other than Johnson & Johnson, ticker symbol JNJ, who has increased their dividend for 60 years in a row. Literally, 60 years in a row they have increased their dividend, which is absolutely insane. And if you want to know the average 5-year dividend yields for these companies, I am circling them right now. So overall, Johnson & Johnson, which is a very prestigious healthcare company, is an absolutely phenomenal hold, and to me, it's probably the #1 dividend stock to hold just because it's such a stable company. The dividend safety score for this company literally comes in at 99, and the current stock price is trading at around $180 per share, and the author of this particular article says that the company should be trading at around $194, which clearly means that the company is trading at a discount right now, which indicates that it could be a good buying opportunity, especially during times of uncertainty. The next company we have on our list is Procter & Gamble, ticker symbol PG, and this is another defensive company that is in the consumer staples industry. Mainly when we're talking about defensive companies, we're really going to hone in on those healthcare companies and those consumer staples, because these are the types of things that investors and everyday customers can't live without. Procter & Gamble has an even more impressive consecutive dividend increase for 66 years in a row, and they have an average 5-year dividend yield of 2.72%, which is rather high. Again, they have an absolutely phenomenal dividend safety score of 99, with the best being a 100. However, no company actually has a 100 because there is always that 1% risk that we have to account for. The company currently trades for around $142 per share, and because the stock price is currently trading below $154, it indicates a good buying opportunity because the company is trading at a discount. Now, this doesn't mean that the company couldn't continuously fall in the future. It means it's trading below its fair value price of what the company should be trading at. Now, next up, we have ticker symbol ADP, which is Automatic Data Processing, and they are an information technology company that we do not have a check mark next to, but that doesn't mean they're not a good company. It just means they are not a defensive stock that falls either under consumer staples or healthcare. ADP is still a very strong dividend aristocrat, increasing its dividend for the last 47 years in a row. They have an average 5-year dividend yield of around 2.03%. They have a 97 for their dividend safety score, and again, the company is trading at a discount from their fair value price of $234 per share. Lastly, we have one of my favorite stocks, which is Walmart, ticker symbol WMT, and Walmart clearly falls under the consumer staples sector. So not only are they a phenomenal dividend stock and a phenomenal defensive stock, this company actually has a good amount of growth, even though it's a high-end blue chip company. Walmart has increased their dividend yield for the last 49 years in a row. Their dividend yield is not as high as the others, only coming in at around 1.89% for their 5-year average, and their dividend score is still very good, coming in at 90. Investors think that the company should be worth around $145 per share right now, which means that according to its current stock price, it is trading at a huge discount, because right now the WMT stock is trading for $123 per share. Now, these are the top 4 companies, and these are going to be the main stable heavy hitters that are going to bring stability to your portfolio. These companies are not going to make you super rich. However, they are extremely stable, and they're going to prevent your portfolio from losing too much money during times of stock market volatility, uncertainty, and even market crashes. Also, they're going to give you that phenomenal passive income because their 5-year average dividend yields are pretty decent, and these dividend yields are set to increase as time goes on because, again, these are phenomenal dividend aristocrats. But now that we have the top 4 companies out of the way, what about the other companies? So here is the list of the other companies, and like I did before, I have a red dash over the companies that are considered defensive companies. So for these companies, we're going to start off with Medtronic, ticker symbol MDT. So Medtronic is a healthcare company, which again makes it a defensive stock. They have a very impressive track record of of 45 years worth of increasing their overall dividend yield. And again, like we did on the other chart, we're going to highlight their 5-year average yield so investors kind of know what type of passive income they're going to receive from these companies. Right now, the MDT stock trades for $88 per share, which gives the company a fantastic discount, which means the company is a good deal right now because the fair value estimate for the company is around $124 per share. It has a fantastic dividend safety score of 99. Also, if you didn't know what the dividend safety score is, it's the threat of them either not increasing their dividend or not being able to give investors or paying out a very good dividend. And to me, for a safety score, anything above 70 is pretty good. And for Medtronic, they are an absolute phenomenal buying opportunity, especially if you want stable passive income. The next company is General Dynamics, ticker symbol GD. The company currently trades for $216 per share. It has a 31-year track record of increasing their dividend yield. The average 5-year dividend yield for this company is 2.25%, which is not bad and is trading at a slight discount. The dividend safety score is also pretty solid, coming in at around 97. Now let's move on to Pepsi, which is a company that I personally own. I own both Pepsi and Coca-Cola, which is also on this list. And their 5-year average dividend yield is 2.93%, and it's trading at a slight discount. Now, I clearly think that investors could get this company for cheaper. It's just barely trading at a discount because the fair value price target for this company is $170, while the current stock price hovers at around $164. But nonetheless, the company does have a check mark next to it, which indicates that this is a defensive company because this company is in the consumer staples sector. The company after Pepsi is called Ecolab, ticker symbol ECL. And Ecolab has increased its dividend yield for 30 years in a row. However, its dividend yield isn't very strong because its 5-year average is around 1.07. And although that's not very high, as time goes on, remember, they're going to be increasing that dividend yield. Also, they are a very safe company because their dividend safety score is a 98, and this company is trading at a substantial discount right now because the fair value estimate is $192 per share and the current stock price is $154, so clearly this company is trading at a huge discount. The next company we're going to talk about is named Air Products and Chemicals, ticker symbol APD, and this is a materials company that has increased their dividend for 40 years in a row, with their 5-year average coming in at around 2.33%, which is not bad, and they have a solid dividend score of 95. The company, again, does not have a check mark next to it, so I'm not going to spend too much time on this company, but they are trading at a decent discount from what analysts and other financial institutions deem the company should be worth at around $285 per share. However, now I want to talk about Colgate, ticker symbol CL, and this is another consumer staple company, which is why it has a check mark next to it, because consumer staples and healthcare mean that this company is most likely a defensive stock, especially if it's a dividend aristocrat who has a 59-year track record of increasing their dividend, and they have a solid dividend coming in at a 5-year average of 2.38% and a 90 when it comes to their dividend score, which again is very solid. However, this is a company that I'm not overly bullish on. I do think that investors could wait for the company to fall down a little lower in price, but the problem is that the company is so stable, it's probably not going to drop below a 10 to 15% discount. So if you want to add stability to your portfolio and you want to receive passive income in the form of dividend payments, then maybe the CL stock could be for you. After Colgate, we're going to be talking about the ITW stock, which is Illinois Tool Works, and they have also increased their dividend for the past 59 years. Their 5-year average is 2.37%, and they have a dividend safety score of 81. Moving right along to another one of my favorite dividend companies is Coca-Cola, ticker symbol KO. As you probably know, this is a consumer staples company that sells beverages all over the world. They are a phenomenal blue chip company. They've increased their dividends for around 60 years consecutively, and they have a very high dividend coming in at 3.27%. Their dividend score is 80 for their safety, and according to this chart, they are trading exactly at their fair value at $61 per share. The company after Coca-Cola is Emerson Electric, which currently trades for $77 per share, and their dividend is 2.83% for their 5-year average. The company has actually increased their dividends for 65 years in a row, which is one of the largest dividend increases consecutively on this list. They have a solid dividend safety score of around a 78, and they are trading at over a 10% discount. So feel free to do your own research on that company to see if this company is right for you. Up next, we have a very well-known dividend aristocrat, which is 3M, ticker symbol MMM, which has increased their dividends for 64 years consecutively. They have a very strong dividend coming in at 3.24% and a dividend safety score of a 75. This company is substantially discounted from what investors think the company should be worth right now at $190, even though the company is actually only trading at $130 as of this recording. Lastly, we have Abbott Laboratories, ticker symbol ABT, and this is again one of my favorite companies to buy. I think this company has phenomenal growth and it offers a solid dividend. The company has a 5-year average dividend yield of 1.55% and a 71 dividend safety score, and it's currently trading at a decent discount right now because financial institutions and professionals and financial advisors think the company could be worth around $121 in the next 12 months, and the company is currently trading at only $106 because of the very bearish negative environment that we are finding ourselves in. With the S&P 500 entering an official bear market, we have a recession going on right now because the GDP has decreased for the last 2 quarters in a row. We have rising interest rates and we have investors freaking out, and that's why they are liquidating their stocks, which is causing the stock market to crash. However, I love it when the stock market is falling because that's when I get to buy my favorite companies at a very good discount. Now, the companies in this video, because we are talking about defensive dividend stocks, these companies are absolutely primed to be bought right now, especially during the current stock market environment, because it's going to lower your risk of losses, it's going to generate you passive income, and it's going to add stability and resilience to your overall portfolio, and it's going to help you grow your wealth over the long term. So the companies mentioned in this video are the top 15 dividend companies according to this particular author. However, again, if you want to check out this article for yourself, all of my sources are always listed and linked down in the description box down below. Here again are all the ticker symbols of all the dividend aristocrats or the really good dividend companies that are currently circulating in the S&P 500 index right now. And remember, if you want more videos like this one where I go over some of my favorite stocks and some other stocks that I think should be on your radar, remember to go and smash that like button, subscribe if you are new, comment down below what kind of video you want to see next. Do you want to see me analyze more dividend stocks, high dividend yield stocks for passive income, growth stocks, my favorite risky growth stocks, or my favorite ETFs to build wealth over the long term? So remember to go and comment down below, and I will see you in the next YT video.